Hello and welcome to Money Control. We continue with our special series for 2025 on 5 big ideas for 2025 to navigate 2025. And today we have a very special guest, Hiren Ved, Director and Chief Investment Officer of Alchemy Capital. And he's going to talk to us about 5 big trends that you should ride on or invest in 2025 for great returns in the future. Thank you so much, Hiren, for joining this morning.
Thanks, Mahalakshmi. Happy New Year to you.
Thank you. Thank you. Same to you. And how has this new year started for you? It looks like the markets are whining a bit.
Yeah, they are. I mean, there's a lot of volatility. There's a lot of anticipation of events. And as you know, markets hate uncertainty. And I think that what's happening right now is that markets are digesting a combination of a cyclical slowdown in India, both in economic growth and earnings, and some of the uncertainties that usually crop up with, President Trump coming, what kind of trade policies is he likely to implement? And then the usual butterflies about the budget, right? So all of that put together is kind of creating a level of volatility and uncertainty in the markets. Not that we haven't seen something like this before, but I guess we can't escape some of these things.
Right. And if you were to map 2025 and say which year in the past would you think 2025 is likely to be, what would you say?
Well, difficult to say because no year is the same, but at least the way 25 has started could be like 22, right? Because in 22 we had interest rates rising and cost of capital going up.
Right.
And while everybody's expectation is that the Fed and the RBI will cut,
right,
the fact of the matter is that bond yields have been strengthening in the US.
Correct.
We don't know if it's a permanent feature or it's a temporary spike before things cool down. But at least the start of 25 is looking like how it was in 22. Nervous.
Right. And let's get started with the ideas.
Sure.
First idea.
And I think it's not just an idea for 25, but it's something that we've been talking about, which is that traditionally India has been very strong in services. That's also borne out by the fact that our export of services is bigger than our export of manufacturing.
Correct.
But I think we are trying to find our feet in manufacturing. And we had a lost decade between 2010 and 2020 in manufacturing. But I think post-COVID, we've seen a kind of a renaissance. And I would break this up into 2 areas from an investable perspective, right? One is the traditional areas where we were always strong. Auto components, pharma generics and CDMO, chemicals, engineering goods. We've had Indian companies exporting. And we're already part of the global supply chain. China plus 1 is just a new acronym that everybody uses, but India always had some strength in these areas, right? Yeah. And that will continue, in my view. It's not going to go away. The new areas, which if you look at the history of electronic manufacturing, which is usually low-end assembly, components, etc. The manufacturing centers travel to geographies where the costs are the lowest.
Right.
And it was in Japan earlier, then it moved to Korea, then it moved to China. Now it's moving to India.
Right.
Right. But it's a large opportunity. It's a 70, 80, maybe even $100 billion plus opportunity.
Right.
And our companies are still very pygmy sized here. And therefore, at least there will be 20, 25 companies which will be born out of doing various things in electronic manufacturing, semiconductors, etc. Right? The whole ecosystem will come to India. Apple helped to get that ecosystem.
Right.
Now we're slowly building that ecosystem. So my feeling is that electronic manufacturing is going to be like how IT services was in the 90s.
Okay.
Right? There was no only one Wipro, one TCS, one Infosys. There were scores of software companies which grew.
Right.
There will be obviously a few leaders, but I see the same trend in electronic manufacturing as well. Simple stuff, making refrigerators, IT hardware, mobile phones, air conditioners, and maybe we will also get to some high-tech areas like aerospace, defense, right? That is another area where traditionally India has only been importing. But I think slowly the aerospace manufacturing supply chain is coming to India. Defense, India is spending more and more on domestic manufacturing, and also we have aspirations to export to other smaller countries, right? So I think there are two new areas which were not there, electronics and then defense and space tech. These are the two new areas where I think there is huge opportunities. There'll be small companies which will become multi-million dollar, maybe some of them will become multi-billion dollar market cap companies in this area.
Right.
Now you have to pick and choose amongst these.
So what are give us some names that are already in your portfolio or something that you will look at?
So again, again, without giving names, but I think we do own the top 2 EMS companies, right? But I also believe that there will be several more that will come out of that. In defense, we do own the top 2 and then a few other smaller companies which are within the supply chain in defense and aerospace manufacturing, right? But there will be many more that will come.
One question is that, this EMS space that you talk about, or the defense space, has been in play over the last more than 3-4 years, right?
Yeah.
And the worry is always that, you might pick the right company, but are you paying the right price?
Yeah.
So you do think that for anybody who's holding on, what's your view? Because that's, I think, an easier call. You're sitting on money. You can still sit on money and say that, even if I lose some, it's okay. But for somebody who's looking at it afresh, would you recommend these spaces?
So yes, you're right that, the size of the opportunity being big and the fact that these companies can grow at high rates of growth over the next few years is to some extent reflected in the valuations, right? So to that extent, there is always a risk. There can always be a few quarters where things don't fall into place.
Right.
There is nothing which is a one-way smooth curve, right?
Right.
But I still believe that the opportunity is so large. And what happens initially is that you get higher valuations because there are very fewer companies to bet on.
Right.
But as instead of 5 companies, if you have 20 companies to bet on, then the valuations then tend to become more normalized, right? So I think that's what's likely to happen. High Ps attract more supply of paper, right? Because some privately held EMS guy will say, oh, if this guy is getting this valuation, then I will get a great valuation, and then he would want to go public. And then suddenly you have a large supply and choice. And then valuations then tend to get more reasonable over time. So I think for investors, again, this is an early area. There will be new opportunities and there will be cycles. Even within a growth cycle, you will have companies which correct dramatically. It's happened in every sector. It will happen in
I think in EMS and defense that we are talking about this year itself. In some of them, I think some of the leaders that you talk about also, we've already seen 30% cuts.
Yes.
So and I'm not wrong. I'm not sure whether what I'm saying is right now or not. But a few months back, we did a very simple implied growth for most of these companies, just with Bloomberg estimates. And none of them show implied growth of less than 30%. They're all upwards of 30%. Is that something that makes you comfortable? Because, just like, I mean, if we just rewind back to the IT services era.
No, the risk is for real, right? I mean, we do tend to look at near-term strong growth rates and imply that kind of project that growth into the future, right? And I think the way to tackle that is sometimes not just the PE multiple, but you have to look at absolute market caps. Okay. Let's say a few years ago, when NBFCs were the in thing, there was no NBFC which had a market cap in excess of 1 lakh crores. Right? They were all small, 10, 15, 20,000 crore market cap. And then when the sector boomed, you had somebody like a Bajaj, which is now 4.5, 5 lakh crores of market cap. And then there are a few more which are getting there. So you have to look at, instead of PE multiples, you have to look at the absolute size of revenue and the absolute market cap that can be achieved in these areas, right? And nothing happens overnight. So you will have these deep cycles of correction because we overestimate, and then the reality could be a little different from where we overestimate. But over a fairly long period of time, you can get big winners in sectors that are likely to grow.
So would you think a large part of the opportunity set for this is outside the public markets?
No.
Considering the valuation.
No, I think there are smaller EMS companies today in various areas which are still reasonably priced. You have to look for them. You'll have to do the hard work to look for them.
And the second idea is
IT services. Again, a very traditional, strong area of growth for India. And why I'm bullish is because I think every technology curve, right? When it was digital, our IT service companies rode the digital wave. When there was ERP, we rode the ERP wave. When it was cloud, we rode the cloud wave. And now AI. If you see what's happening around the world is that there is billions and billions of dollars of IT infrastructure or AI infrastructure that is being built.
Right.
Data centers, cloud. But ultimately, you have to run some application on that infrastructure to utilize that to your benefit. Right? You're not putting up so much of infrastructure to put in a search query and say, write a poem for me or draft an email for me or so on and so forth. There will be, every industry will think how to evolve and use AI to its benefit to improve productivity and so on and so forth. And that's where I think the Indian IT services companies will benefit. So currently there is massive investment in the infrastructure layer. But soon this investment will need an ROI. And that's where the spending will start on the application layer. And for that, which means you have to first clean up your data. You have to have the data in your organization all nicely cleaned up. And then you need somebody to tell you how you will embed some of these AI applications in your company to drive improvements. And for that, you will need a TCS or an Infosys or an Accenture or a Latent View or a Persistent or whatever, right? Scores of these companies who will help you in building that capabilities in real businesses. Because, tomorrow a bank will wake up and say, okay, now, the board says, okay, what are we doing about AI? Or a consumer company which will wake up and say, okay, this AI is a big wave. How do I use AI in my business to drive revenue growth, productivity, blah, blah, blah. And then you'll say, okay, I need help. I need somebody to help me conceptualizing, thinking, going through my process and figuring out how am I going to benefit out of this? So I think the Indian IT companies will have a big role to play.
And again, in IT services, of course, if you look at the rest of the market, it looks like they're underpriced. I mean, but today, historically speaking, a TCS would be 30 times trailing earnings, maybe about 27, 26 times future earnings. Similar for other top tier companies. Is that good enough price for you to buy now?
Great
Because
question.
despite all this conversation about near-term growth may not be good, and all of that, stocks have not done too badly. They haven't performed very well, but
Yeah.
they haven't done too badly either. So therefore, the valuations have not really corrected. So
And
much.
that's because even with a slow growth rate, they still generate a lot of cash. Right. So they've not been great compounders, but then it's not been bad.
Correct.
Right. And then every few years you get a rupee depreciation that helps you a little bit, which is what is happening this year. And then every few years you get one technology wave which lifts growth until growth goes back to single digits. So I think the problem with the large tech companies was that growth was coming down to mid single digits. But therefore, they were hardly growing in double digits, right? But you get returns which were equal to earnings growth plus very good dividend payouts and buybacks. So that was adding to some level of compounding there.
Right.
Now there is hope that if the US economy is likely to do well, and on top of that, we're going to have an AI wave, then IT spending should spike up, and maybe we'll see a good 25 and 26 to ride this wave, right? Now, whether you should buy a mid-size company which is more geared and nimble-footed to take advantage versus, let's say, a big cap tech company. I mean, that's again depends on how big a portfolio you're running. If you're a mutual fund, you may still have to have exposure to larger companies. If you are, a smaller individual investor or a smaller portfolio, you can have more exposure to mid caps.
Mid caps are even more pricey, isn't it?
Because they were growing faster than the large caps, right?
But now even their growth has tapered off.
Yes, their growth has also tapered off. And that's why many of them have corrected as well from the top, right? So markets are very smart. I mean, they don't allow any anomalies to continue for too long unless there is a very good reason for those anomalies to exist.
One of the conversations now happening around IT is, how this Trump thing is going to play out. And, it is just reasonable to expect that there might be some pressure on margins if, the visa costs go up or any of the other if you just extrapolate what happened when the regime was not really favorable. Do you think this year will offer you an opportunity or a correction for you to sort of dive in to ride this wave, or is that all priced in also?
I hope there is no very large scale disruption, right? I mean, there was a talk in which, again, you never know, a lot of these things are flying around, that India's largest export to the US is actually IT services.
Correct.
GCC centers in India, and they need the people and the expertise to keep those companies competitive. I mean, if Microsoft has so many engineers and Google has so many, it would be counterproductive for them. And considering that he has so many tech czars in his cabinet, so to speak, there is a very low probability that he would do something like that. So I think you don't know what will happen, but if it happens, I think it will be a great opportunity to buy actually in that disruption.
Third idea.
Third idea is the birth of the digital platforms in India, right? I think finally we are seeing, real first generation entrepreneurs who have benefited from the tech stack or the digital stack that India has built, the combination of UPI, the whole payment system and so on and so forth. And we are seeing the birth of a few great disruptions, which are changing the way many industries are working, right? And the biggest of that we are seeing in the consumer businesses. The platforms
Right.
have come and actually fragmented the industry. So what happened was that GST and demonetization consolidated the industry in favor of the more organized players.
Correct.
The unorganized players were at a disadvantage. But now the tech platforms are enabling smaller, organized, nimble players to take birth. And they are eating away at the margins of a large consumer category. Right. So
for example, give me an example of what you're saying.
For example, what Nykaa has done, right? For example, you see lot of suddenly, if you thought foods in the traditional way, you would think of Nestle, ITC, right? But now you have lot of smaller food brands which are growing, or what they call the D2C brands, which are growing because they can bypass this traditional moat that FMCG companies had of building deep distribution.
Right.
Because now you can advertise on a social media platform or an e-commerce platform, which means you can get access to the customer and you can get that customer's attention. The big brands were advertising on TV and in newspapers, which was very expensive advertising, right? But today, you can go on Instagram and you can promote a product. You can get onto an Amazon or a Flipkart or an ONDC for that matter, any of these platforms to make your product accessible. And the payment mechanism is all digital.
Correct.
Right? And you have a third party logistics player like, let's say, a delivery, for example, who can pick up the product and deliver it to any pin code. So if you see the entire value chain of a typical consumer company was that they created their own value chain. They had their own distribution, retailer, wholesaler, sub-distributor.
Right.
They created a brand. They promoted a brand. They got the manufacturing outsourced, but rest of the stuff they were doing.
Correct.
Now, a new company will only focus on brand building and product.
Right.
They can outsource manufacturing. They can outsource logistics. They can access the customer much more easily because everybody is on the phone. And therefore, all these brands are converging on a platform. And the platform is a place where the consumer goes again and again, right? So you have the Zomatos, the Swiggis, the Paytms, the Phone Pays of the world. There are a few of them who have created a community of millions of customers who come again and again.
Correct.
Because you're providing that service. So a Zomato is a classic example of how many restaurants have got an opportunity to serve you. Because otherwise you would only go to a place which is closer geographically, access to you. Today you can go, right? So I think the birth of the platforms is likely to bring both opportunities and disruptions.
So what will you bet on? The digital platform companies or the
platforms, right? Because the platforms is where they are aggregating customers. So think of a platform as a highway, right? And initially you said that there is no toll on this highway. Just come and drive your car, right? And then you got traffic first on the toll road. Then slowly on, because you have so much of traffic coming on your toll road, you suddenly put a restaurant there or a food joint. And then people who come there, maybe they want to eat food and that's how you monetize it. Or you put up a gas station and somebody comes there and you monetize it. Or you put up a hotel and somebody wants to stay and you monetize it, right? So I think the UPI or any of these platforms, they obviously initially spent a lot of money to get the customer on the platform by providing some service.
Right.
And they initially priced that service very competitively. So for example, Zomato would say free delivery, right? Now, slowly, as the customers have come, they've got used to the service. platform fee 2 rupees, then 5
Yeah.
rupees, get 500 million subscribers. And now once the competition is kind of decimated and you're down to 2.5 players, now
Then
you
you can-
start to monetize that bit by bit,
Right.
right?
Do you see any significant price risk to these stocks?
There could be. There could be. I mean, was there not a time, if you go back and jog our memories, where Lever and PNG were fighting tooth and nail and created a price war? And nobody made money until the price war was settled. Or there was a phase when, when raw material prices were low, there were a lot of regional brands that came up.
Correct.
Nirma, for example, was born during that time to challenge a Lever, creating a low-cost brand.
Right.
So, no matter what, every industry will go through its competitive dynamics. And I think that's what's going on right now. Everybody is fearing that everybody wants to do quick commerce.
Yeah.
Zepto has raised capital. So, everybody...
does this year or current prices offer you a good opportunity to enter the sector as an investor in the secondary markets?
I think so.
Okay.
I think so. I think if you're a long-term investor and if these stocks correct, I look at them as multi-year businesses, right? It's not easy. And why I'm saying that is because it's very difficult now for a new player like a Zomato to get funded.
Right, correct. The environment has changed.
The environment has changed,
completely,
right? So, when there is a new sector, everybody is excited. Everybody funds similar businesses. And there is a lot of competition, and then supply catches up. And then there is consolidation. A lot of them die.
Right.
And some of them survive.
Right.
I always ask a question, if that was so easy, how come there was no great food delivery company from the stable of the Tatas or any other of the large groups? Did they not have brand, money power? But that's not how it works. It's enterprise.
Right.
It's enterprise,
Of course.
How you innovate, and the beauty of the secondary market is that you can decide when you want to join the journey.
Right.
The train is going from Churchgate to Borivali, right? You decide whether you want to sit in Churchgate and ride till Virar, or you want to get in at Dadar or some other station.
Right. But where are we right now? Are we at Dadar? Are we at Dadar? Are we at Goregaon? Where are we?
The train has just left from Churchgate. We are still at Marine Lines or Churni Road, right?
Okay. Fair enough. So that's the third idea, digital platforms. Fourth idea.
I think the premiumization of the consumer, right? We're seeing across the board that there is that 50-70 million consumers at the top who have a lot of purchasing power. And, we generally talk about the middle class and the 500 million, but if you break up the per capita, then really it's at the top quartile is where the purchasing power is. And now we are seeing that purchasing power being reflected in consumer choices. So everything which is premiumizing is doing well. Right. So whether it is real estate, whether it is expensive branded liquor, whether it is travel, right? And across whether it is SUVs versus small cars, right? Premium motorbikes versus entry-level motorbikes. In sector after sector, we're seeing the birth of the emergence of this premium customer who has a taste and is willing to pay a higher price for an experience or a better product. And therefore, I think that this is a long-term trend, right? And this is going to persist, right? So there are several ways to play it. You straight have brands, companies which have brands, a retailer who's probably doing high-end jewelry or liquor or or maybe a great hotel company,
Right.
and so on and so forth. But across the spectrum,
Right.
premiumization is where I think the demand has been, and it's a secular trend.
And your fifth idea.
Which we are all beneficiaries of, which is the financialization of savings.
Right.
Right. So I think, people are now.
So how many times did Alchemy's assets grow over the last 5 years post-pandemic?
Oh, we've grown at least 3x from where we were. Right.
Fantastic. Okay.
And because today the average investor is willing to diversify his investing side of the balance sheet, the asset side of the balance sheet, beyond fixed deposits, beyond PPF,
Correct.
beyond all the fixed income. And also what has happened over time, the governments have taken away the large tax-free benefits that were there in many of these fixed income instruments, because they were, even the rich guys were abusing it, right? I mean, I could technically put a lot of money in PPF and get 9 or 10% interest-free returns. That's a great, but then the government is paying that, and eventually everybody else pays a cost of that. So I think as structurally interest rates fell, as some of the tax benefits on fixed income went away, on a post-tax basis, equities became a very serious avenue.
Right.
And I think that is where we are seeing the financialization of savings happening through these SIPs, through capital markets, now slowly through REITs and stuff like that. And today, access to information, access to doing a transaction has become much more easy. We're talking about T+1 and T+0, so it's become, and with these digital platforms, information is ubiquitous, access is ubiquitous, right? And the returns, even on a post-tax basis, are far more attractive than what you would put. And that's why you see that, as I said, from an investment perspective, if the consumer is moving from fixed deposits to mutual funds, then why should I buy a lender? I should buy a capital markets company.
Correct.
Right? From an investor, just a long-term investment perspective.
Right.
I'm not saying that, banks will go out of business or anything like that. It's just a phase. It's a phase where we are going to see that point that we always wished ki domestic savings aega in capital markets. Finally, it's coming.
Correct.
And I think that wealth managers, asset managers, brokers, all the market infrastructure intermediaries are likely to benefit because of this digitalization and financialization of savings. So that's a big opportunity.
Right. So in terms of valuation, how would you size up banks versus the asset management companies, or even broking? Despite all of this, it's not really corrected so much. All this F&O, people were saying that, it'll take away a lot of the top line.
So Mahalakshmi, I think this question is all pervasive across sectors, right? What is happening is that wherever there is growth, valuations are reflecting that.
Correct.
Now, the question therefore is that you have to therefore reconcile that, are you paying right for that growth? How durable is that growth? And how much of that is already in the price? And there is no one right answer that I can give you, right? So people tend to say, oh, this is high P, so let me buy something which is low P.
Right.
But that does not necessarily work, right? But markets are far more complex than that. So for example, what we are seeing right now is that sectors which underperform now for the last 2-3 years, because there was very little expectations, even if they are showing a slight improvement, the markets are rewarding it very handsomely, right? Because expectations are already low. Not that growth rates have come back in a big way, right? It's more a play of expectations versus reality.
Hmm. Hmm.
And on the other side, the ask rate is very high. So there is very little room for disappointment in the typical growth areas that I talked about. And therefore, you have to be ready for drawdowns if there are disappointments.
Right.
Because, yes, there is a lot of growth ahead, but then the valuations are also capturing reflecting that. And therefore, the answer is not one or the other. The answer in the way investors should invest or we build portfolios is to have the healthy mix.
Right.
Between sometimes it's a trade-off, right?
Right.
So, if you want very reasonable valuations, you should be happy with reasonable rates of growth, and where especially there has been a lot of disappointment and there could be a potential for an upward surprise.
Right.
And similarly, on the other side, you have to be ready that you can have a negative surprise.
Sure.
Right. So it's how you create a balance between these is how investing is all about.
That's not something you can explain in this interview. For
not
sure.
In 2 minutes.
It's a lifetime of work. On that note, thank you so much,
Thanks
Hiren. That's all we have time for. Thank you, and hope you all have a profitable 2025 and benefit from all the ideas that Hiren has shared with us. Thank you so much.